While you've been pumping money into S&P 500 index funds, investors in India have been enjoying 25% earnings growth year after year. That's not a typo. Many emerging markets are absolutely crushing U.S. returns, and most Americans have no idea. In the next 10 minutes, I'll show you exactly how everyday investors like Mike from Ohio transform $10,000 into over $75,000 by simply allocating 20% of their portfolio to these overlooked markets. Don't worry, you don't need a foreign bank account or fancy connections to tap into these gains. The tale of two investors, Mike versus Connie. Let me take you on a journey of two investors who started at the exact same point, but ended up in completely different places. Meet Jeremy. 5 years ago, Jeremy did what most financial advisors told him to do. He put his entire $50,000 savings into S&P 500 index funds. Smart move, right? That's what everyone from Warren Buffett to your neighbor's financial advisor recommends for long-term growth. Jeremy felt confident in his strategy. After all, the S&P 500 had been delivering solid returns for decades. He could set it and forget it, knowing he was following conventional wisdom. Jeremy would check his portfolio occasionally, watching it grow steadily, and pat himself on the back for being financially responsible. Now let's meet Connie. Connie also had $50,000 to invest 5 years ago, but she took a slightly different approach. While she put 80% of her money into those same S&P 500 index funds, she decided to allocate the remaining 20%, just $10,000, to emerging markets that most Americans never even think about. That sounds risky, Jeremy told her when they discussed their investment strategies over coffee. The U.S. market is the safest bet. Why complicate things? But Connie had done her homework. She understood something that Jeremy didn't, that looking beyond America's borders could potentially supercharge her returns. Let's fast forward 5 years and check in on our investors. Jeremy's portfolio, which started at $50,000 and was 100% invested in the S&P 500, has grown to approximately $62,000. That's a respectable 24% gain over 5 years. Nothing to sneeze at. But Connie, her portfolio tells a much different story. Her $50,000 investment has ballooned to over $75,000. That's a 50% return, more than double what Jeremy achieved in the same time frame. How did this happen? The 80% of Connie's portfolio that was in the S&P 500 performed exactly the same as Jeremy's investment, growing to about $40,000 from the initial $40,000 she put in. But here's where things get interesting. That $10,000 she allocated to emerging markets? It more than tripled to over $35,000. Look at the math. $40,000 from her S&P 500 investment plus $35,000 from her emerging markets allocation equals $75,000 plus. All because she decided to diversify globally with just 20% of her portfolio. What's even more fascinating is that Connie's portfolio actually had less overall volatility than you might expect. While her emerging market investments did experience some ups and downs, these fluctuations often occurred at different times than the movements in the U.S. market. When one zigged, the other sometimes zagged, creating a smoother overall growth trajectory. Connie represents the minority of American investors who've discovered the wealth-building potential of global diversification. Jeremy, unfortunately, represents the majority, those who are missing out on massive global opportunities due to what financial experts call home bias. Home bias is the tendency to overweight investments in your home country while underinvesting internationally. And Americans have this bias bad, really bad. Most American investors have less than 15% international exposure in their portfolios. That might seem reasonable until you realize that U.S. markets represent less than 60% of global investment opportunities. Think about that for a second. If you're only investing in U.S. companies, you're essentially ignoring more than 40% of the world's investment opportunities. That's like going to a buffet and only eating from less than half the dishes available. But the U.S. market has been crushing it, I can hear some of you saying. And yes, over the past decade, U.S. stocks have indeed outperformed international markets as a whole. But that's not always the case, and more importantly, specific emerging markets have absolutely demolished U.S. returns during the same period. So what exactly did Connie invest in that Jeremy didn't? Her international allocation wasn't just blindly throwing money at foreign stocks. She strategically targeted specific high-growth regions and countries that were positioned for explosive economic expansion. Connie put her international allocation into a carefully selected mix of emerging market ETFs, focusing on countries with young populations, growing middle classes, and robust digital adoption rates. Countries where corporate earnings were growing at 18 to 25% annually, far outpacing the single-digit growth of most U.S. companies. While Jeremy's investment approach wasn't wrong, it was incomplete. By ignoring international opportunities, particularly in emerging markets, he left significant money on the table. The $13,000 plus difference between their portfolios might not seem earth-shattering at first glance, but multiply that effect over 20 or 30 years, and we're talking about potentially hundreds of thousands of dollars in missed opportunities. What's even more eye-opening is that Connie didn't have to become an international investment expert to achieve these results. She didn't need a special brokerage account, she didn't need to learn foreign languages, and she didn't need to stay up all night tracking overseas markets. She simply allocated a portion of her portfolio to accessible ETFs that gave her exposure to these high-growth regions. The difference in their results also challenges the conventional notion that international investing is riskier. While individual emerging markets can indeed be more volatile, when properly integrated into a portfolio, they can actually reduce overall risk through diversification while simultaneously boosting returns. Imagine if Connie had told Jeremy about her strategy 5 years ago, and he had followed suit. They'd both be $13,000 plus richer today. That's the thing about investment knowledge. Sharing it helps everyone win. The story of Jeremy and Connie illustrates a crucial point. What you don't know about global investing opportunities could be costing you thousands in potential returns. And the worst part, most Americans have no idea what they're missing. I want you to ask yourself a question. Is your portfolio more like Jeremy's or Connie's? If you're like most Americans, you probably have minimal international exposure, and that's leaving money on the table. The good news is that it's not too late to make a change. You don't need to radically alter your investment strategy. Even a modest 20% allocation to strategic international markets could significantly impact your long-term returns. Connie's investment journey didn't require perfect timing or specialized knowledge. She simply understood a fundamental truth about wealth building. Expanding your investment horizon beyond U.S. borders opens up a world of opportunity that most Americans completely ignore. The home bias trap: why Americans are missing global gains. The invisible force holding back millions of American investors isn't market volatility or economic uncertainty. It's something happening inside their own minds. While most Americans cling to their homegrown stocks like security blankets, they're actually exposing themselves to more financial risk than necessary. This psychological barrier costs the average U.S. investor thousands in potential returns every year, and worst of all, most don't even realize they're trapped by it. Have you ever wondered why you mostly own American companies when the U.S. represents only 25% of the global economy? This puzzling disconnect isn't unique to you. It's a well-documented psychological phenomenon called home bias. Simply put, home bias is our natural tendency to favor investments from our own country while ignoring potentially better opportunities abroad. Think about it. When was the last time you heard someone at a dinner party excitedly discussing their Vietnamese stock picks or Polish ETFs? Probably never. Instead, conversations revolve around Apple, Tesla, or maybe an S&P 500 index fund if someone's feeling particularly adventurous. This collective tunnel vision isn't just limiting our cocktail party conversations, it's actively shrinking our investment returns. The numbers tell a shocking story. Studies show that American investors hold less than 15% of their money in international markets, despite the fact that non-US investments represent over 40% of global opportunities. That's like walking into a buffet and only eating from one corner of the table. And this isn't just about missing out on a few exotic flavors. This bias has real financial consequences. But why do we do this? Part of the explanation is purely psychological. We feel more comfortable with what we know. American companies have familiar brands, they report in our language, and their CEOs appear on our favorite news channels. There's a false sense of security in familiarity, even though proximity doesn't guarantee better performance or lower risk. Another major factor is our media environment. Turn on CNBC or open the Wall Street Journal, and what do you see? constant coverage of the Dow Jones, S&P 500, and U.S. corporate earnings. International markets might get a brief mention if something dramatic happens, but the day-to-day developments in thriving overseas economies barely register in our financial media. This creates a massive information gap that reinforces our home bias. Out of sight truly becomes out of mind and out of our portfolios. The financial consequences of this bias are substantial. Over the past decade, emerging markets have experienced periods of explosive growth that made Connie's returns possible. By ignoring these opportunities, American investors have left significant money on the table, potentially tens of thousands of dollars for the average long-term investor. But here's where things get really interesting, and where most American investors get it completely backward. Many avoid international markets because they seem risky compared to U.S. stocks. Yet research consistently shows that adding international exposure actually reduces overall portfolio volatility over time. This seems counterintuitive until you understand the concept of correlation. Markets in different countries don't always move in the same direction at the same time. When the U.S. market takes a downturn, other markets might be stable or even rising. By spreading your investments across multiple countries, you create a natural cushioning effect against market volatility. The optimal mix for maximum volatility reduction occurs when you allocate between 20% and 50% of your portfolio to non-U.S. stocks. This sweet spot provides the best balance of growth opportunity and risk management. Exactly the approach Connie took that Jeremy completely missed out on. Beyond reducing volatility, international investing offers another powerful advantage: currency diversification. The U.S. dollar has appreciated significantly over the past decade, appreciating over 30% since 2014. While that might sound great for patriotic reasons, it's actually created a headwind for Americans investing abroad, as foreign returns get diminished when converted back to stronger dollars. But currencies move in cycles, not straight lines. The dollar won't stay strong forever, and when it eventually weakens, Americans with international investments will get a powerful boost to their returns. Those foreign stocks will not only generate their own gains, but will also be worth more when converted back to a weaker dollar. This currency effect acts as a form of financial insurance that purely domestic investors simply don't have. Now, I know what you might be thinking. Okay, international investing reduces risk and provides currency diversification, but does it actually make more money? Fair question. And this brings us to perhaps the most overlooked advantage of going global: income. International markets currently offer significantly higher dividend yields than U.S. stocks. As of December 2023, non-U.S. equities delivered an average annual yield of 2.91%, compared to just 1.75% for U.S. stocks. That's a 66% higher income stream just for being willing to look beyond our borders. Think about what this means in practical terms. If you have a $100,000 portfolio fully invested in U.S. stocks, you might generate about $1,750 in annual dividend income. Shift just 40% of that portfolio to international markets, and your annual income could jump to around $2,230, an extra $480 each year that compounds over time while you wait for those growth returns to materialize. This higher yield reflects a fundamental difference in corporate cultures around the world. Many international companies prioritize returning profits to shareholders through dividends, while U.S. companies often favor stock buybacks or reinvesting profits for growth. Neither approach is inherently better, but by limiting yourself to U.S. stocks, you're missing out on the choice. What makes this situation even more striking is that these international dividend advantages come at a time when many foreign markets are trading at significant valuation discounts compared to U.S. stocks. You're not just getting better income, you're potentially buying that income at a bargain price. The home bias trap affects nearly all American investors to some degree, even sophisticated ones. It's not something that gets discussed in most financial planning sessions, and it certainly doesn't make headlines on financial news networks that depend on advertising from US-based companies. Breaking free from this trap doesn't require exotic investment strategies or special accounts. You don't need to learn new languages or stay up all night to trade foreign markets. Simple, accessible ETFs trade right on US exchanges during normal market hours, making global diversification as easy as buying any American stock. The uncomfortable truth is that your all-American portfolio might actually be the riskiest approach of all, leaving you overexposed to a single economy and missing out on tremendous growth happening elsewhere. The world of investment opportunities extends far beyond our borders, with international markets offering growth potential, higher income, and proper diversification that simply can't be achieved by staying home. India's economic explosion, the 25% growth engine. Beyond our borders lies an economy that's not just growing, it's absolutely exploding, with 18 to 25% corporate earnings growth compared to the single digits we're celebrating here at home. Ever wondered what investing in America might have felt like during its greatest economic booms? India is creating that exact opportunity right now, and almost no one in your social circle is talking about it. Let's put some real numbers behind this story. While the U.S. economy is projected to grow at a respectable but modest rate, India is on track to achieve a compound annual growth rate of 6.5% in real GDP from 2024 to 2029. That's not just impressive. It's the kind of growth that creates generational wealth opportunities for investors who recognize the trend early. What's driving this explosive growth? For starters, India has something America lost decades ago: a young, growing population entering their prime earning and spending years. While the U.S. and other developed nations struggle with aging populations and declining birth rates, India has hundreds of millions of young workers just beginning their economic journey. This demographic advantage is like rocket fuel for an economy. Think about it. Millions of young professionals buying their first homes, purchasing their first cars, opening investment accounts, and spending on consumer goods. It's an economic perfect storm that pushes corporate earnings into the stratosphere. While U.S. companies celebrate single-digit growth rates, Indian corporations are casually posting 18 to 25% earnings growth. Numbers that would make American CEOs weep with joy. And here's what makes this opportunity even more compelling. India isn't just growing. It's completely transforming its economy through digital innovation. Instead of slowly building traditional financial infrastructure like brick-and-mortar banks and payment systems, India has leapfrogged directly to cutting-edge digital solutions. The country went from predominantly cash-based to one of the world's most advanced digital payment ecosystems in just a few years. This digital transformation has unlocked opportunities that simply didn't exist before. Imagine if America's historical economic booms had happened with today's technology. That's essentially what's occurring in India right now. Hundreds of millions of people are gaining access to financial services, e-commerce, and digital entertainment for the first time, creating explosive growth in these sectors. Let's look at where this growth is most concentrated. The digital payments sector in India has experienced nothing short of a revolution, with transaction volumes growing at rates that would be considered unrealistic in mature economies. Consumer goods companies are experiencing unprecedented demand as disposable incomes rise. And perhaps most impressive is the financial services sector, where companies are rapidly expanding to serve previously untapped markets. These aren't speculative claims. The market performance tells the story. Major India-focused ETFs and mutual funds have dramatically outperformed the S&P 500 over the past 3 to 5 years. While American investors celebrate a good year when their portfolios gain 10 to 12%, many India-focused funds have delivered returns that double or even triple those numbers. But you might be wondering, is this just a temporary boom, or is there something more sustainable happening? The evidence points strongly toward the latter. Unlike speculative bubbles driven by hype, India's growth is underpinned by fundamental economic factors. A growing working-age population, increasing productivity, public investment in infrastructure, and strong consumer demand. These are the classic ingredients for long-term economic expansion, not a flash in the pan. I know what you're thinking. Sounds great, but how do I actually invest in this growth without opening foreign brokerage accounts or dealing with complex regulations? That's the beauty of today's investment landscape. You can access these markets with the same ease as buying any U.S. stock or ETF through your existing brokerage account. So which specific companies are generating these extraordinary returns? Let's look at HDFC Bank as a prime example. This isn't some speculative tech startup. It's India's largest private bank, comparable to America's JP Morgan Chase or Bank of America. But unlike those established giants growing at single-digit rates, HDFC Bank has consistently delivered returns exceeding 20% annually over the past decade. Think about that for a second. While Americans debate whether the S&P will return 8% or 9% this year, investors in companies like HDFC Bank have been compounding their money at more than double that rate, and they've been doing it consistently for years. Another standout example is Tata Consultancy Services, or TCS. This company has become a global IT services powerhouse, competing directly with American tech giants. Its growth hasn't just matched U.S. competitors. It has often surpassed them by wide margins, creating tremendous wealth. For early investors, what's especially interesting about India's market is that you don't need to bet on unproven startups to capture this growth. Many of the best-performing companies are established leaders in their industries with strong balance sheets and proven business models. They're delivering exceptional growth not because of hype or speculation, but because they're riding the wave of India's broader economic transformation. Think about the compounding effect of these higher returns over time. If you invest $10,000 in a portfolio growing at 8% annually, roughly the historical S&P 500 average, you'll have about $21,600 after 10 years. But if you invest the same amount in a portfolio growing at 20%, like some top Indian companies have delivered, you'd have over $61,900 after the same period. That's nearly 3 times the wealth creation from the same initial investment. The skeptics might point out that emerging markets like India come with higher volatility and risk. And they're not wrong. India's market can experience larger swings than the S&P 500. But here's what those skeptics miss. For long-term investors, those short-term fluctuations matter far less than the compounded returns over time. A market that delivers 20% annual returns with some bumps along the way still dramatically outperforms a market delivering 8 to 9% returns with less volatility. And let's be real about another misconception. Many Americans perceive international markets as riskier simply because they're less familiar with them. But familiarity doesn't equal safety. In fact, concentrating all your investments in one economy, even if it's your home economy, creates its own form of risk through lack of diversification. For investors with a time horizon of 5+ years, the math becomes compelling. India's projected 6.5% GDP growth, combined with 18 to 25% corporate earnings growth in leading sectors, creates an opportunity that simply doesn't exist in more mature markets. It's like having a time machine that lets you invest the Vietnam opportunity, Asia's new manufacturing powerhouse. The time machine doesn't stop in India. What happens when a nation shifts from harvesting rice to manufacturing high-end electronics in a single generation? Vietnam's economic transformation is creating wealth at a pace that would make even the most successful American investors double-take. Yet it remains almost completely overlooked in typical retirement portfolios. While most Americans can probably point to Vietnam on a map, few realize this country, smaller than California, is experiencing one of the most remarkable economic transformations in modern history. Just a few decades ago, Vietnam was primarily an agricultural economy with rice paddies stretching across its countryside. Today, it's rapidly becoming Asia's new manufacturing powerhouse. This transformation isn't happening by accident. Vietnam has strategically positioned itself as the go-to alternative for companies looking to diversify their manufacturing operations away from China. Think about it. When Apple, Samsung, and other tech giants need to spread their production risk, where are they going? Vietnam is becoming the answer for many global corporations. What makes Vietnam particularly interesting for investors is that this manufacturing shift isn't just a temporary trend. It's a structural change in global supply chains that's creating massive economic momentum. Companies aren't just dipping their toes in Vietnamese manufacturing. They're building massive facilities and training workforces for the long haul. The numbers tell an incredible story. Vietnam's economy is projected to grow at a compound annual growth rate of 6.4% from 2024 through 2029. For context, that's more than double the growth rate projected for most developed economies during the same period. When you compound growth at that rate over several years, the wealth creation becomes extraordinary. But here's what makes Vietnam truly special. It's not just about manufacturing toys or budget clothing anymore. The country has rapidly moved up the value chain. Vietnamese factories are now producing sophisticated electronics, high-tech components, and premium textiles. This upward shift in manufacturing capability translates directly into higher corporate profits and stronger economic fundamentals. Look at what's happening in Vietnam's electronics sector. What started with simple assembly has evolved into sophisticated production of components for smartphones, computers, and even semiconductor manufacturing equipment. Companies that would have never considered Vietnam for advanced electronics production a decade ago are now building state-of-the-art facilities there. The textile industry tells a similar story. Vietnam has moved beyond basic garment assembly to become a preferred partner for premium brands requiring higher quality and more complex manufacturing processes. This evolution up the value chain means higher wages for workers, increased tax revenue for the government, and more robust growth for the overall economy. What's particularly exciting about Vietnam's growth story is that it combines export-driven manufacturing with the emergence of a growing middle class. As manufacturing jobs increase and wages rise, millions of Vietnamese are entering the middle class for the first time. This creates a virtuous cycle where domestic consumption begins to power economic growth alongside the export sector. This emerging middle class isn't just good for Vietnam's economy. It creates specific investment opportunities in sectors like retail, consumer goods, financial services, and real estate. Companies serving this growing domestic market are experiencing rapid revenue growth that often exceeds even the impressive national GDP figures. For investors, Vietnam's stock market has delivered periods of extraordinary performance. While it experiences more volatility than developed markets, as all emerging markets do, the upside potential has been substantial. During several periods over the past decade, Vietnam's stock market has delivered returns that make the S&P 500 look like a savings account by comparison. Take the Vietnam ETF, VNM, as an example. While not without volatility, this fund has experienced periods of 50% plus returns that dwarf what most American markets delivered during the same time frames. For investors willing to weather some ups and downs, the compounded returns over time can dramatically outpace developed market indices. What's driving this performance? It's not just speculative trading. It's fundamentally about earnings growth. As Vietnamese companies benefit from the manufacturing boom and rising domestic consumption, their profits have increased substantially. And in the long run, stock prices follow earnings growth. Here's where the opportunity gets really interesting. Despite this impressive growth story, Vietnam remains dramatically underallocated in most American investors' portfolios. While professional, investors and global corporations are rapidly increasing their exposure to Vietnam. The average American retirement account has essentially zero allocation to this market. This creates what investment professionals call an inefficiency, a situation where there's a significant gap between an asset's fundamental value and its current price. In plain English, Vietnam offers growth at valuations that simply don't exist in more mature markets where every opportunity has been thoroughly picked over by millions of investors. How can everyday American investors access the Vietnam opportunity? One of the simplest approaches is through the Vietnam ETF, VNM, which provides broad exposure to the Vietnamese market. For investors seeking more targeted exposure, there are also mutual funds specializing in Vietnam or broader Southeast Asian markets that include significant Vietnamese holdings. For those comfortable with individual stocks, several Vietnamese companies have ADRs, American Depository Receipts, that trade on U.S. exchanges, making them accessible through standard brokerage accounts. Additionally, multinational corporations with significant Vietnamese operations offer an indirect way to benefit from the country's growth. What about the risks? Like any emerging market, Vietnam comes with higher volatility than developed markets. The Vietnamese dong has historically experienced periods of depreciation, which can impact returns for dollar-based investors. Political risk exists, though Vietnam has maintained relatively stable governance compared to many emerging markets. Market liquidity can also be a concern, particularly for larger investors. Vietnam's stock market, while growing rapidly, doesn't have the depth of more established markets. This means that buying and selling large positions can sometimes impact prices, creating execution challenges for institutional investors. However, for most individual investors allocating a modest portion of their portfolio, these liquidity concerns are minimal. The Vietnamese government has also been actively working to increase market accessibility and improve regulatory frameworks, which has progressively reduced many historical barriers to foreign investment. Looking ahead, Vietnam's projected 6.4% annual growth through 2029 is supported by several structural advantages. The country boasts a young, dynamic workforce entering their prime productive years. Government policies have increasingly embraced economic openness and foreign investment. And Vietnam's strategic position in global supply chains continues to strengthen as companies seek manufacturing diversification. Perhaps most importantly, Vietnam's transformation is happening at a time when global capital is actively seeking alternatives to traditional investment markets. As investors worldwide look beyond conventional allocations for growth opportunities, Vietnam stands out as a market with both strong fundamentals and relative undiscovery among mainstream investors. Brazil's comeback story, Latin America's resource giant. While Vietnam captures headlines as Asia's rising star, another economic giant is staging a comeback that's flying completely under Wall Street's radar. Remember when Brazil was the darling of emerging markets before spectacularly flaming out in 2015? The smart money isn't just dipping its toes back in. It's diving headfirst into Latin America's resource powerhouse, and the returns are proving exactly why timing matters less than fundamentals. Brazil's story is familiar to anyone who followed emerging markets in the early 2010s. The country rode the commodity supercycle to explosive growth, only to crash hard when commodity prices collapsed. Political scandals, economic mismanagement, and corruption investigations sent investors fleeing for the exits. By 2016, Brazil had become the cautionary tale everyone pointed to when warning about emerging market risks. But here's what most American investors are missing. Since 2020, Brazil has been quietly engineering an economic renaissance that deserves your attention. The country's inflation, once the nemesis of economic stability, has been brought under impressive control. This isn't just a minor improvement. It's a fundamental shift that creates the foundation for sustainable growth rather than the boom-bust cycles of the past. What makes Brazil particularly interesting right now is its strategic position at the intersection of three massive global trends. First, Brazil stands as an agricultural superpower in a world increasingly concerned about food security. The country isn't just participating in global agriculture, it's dominating it. Brazil has established itself as the world's largest exporter of soybeans, a critical crop for both human consumption and animal feed worldwide. Beyond soybeans, Brazil leads in exporting sugar and coffee, creating a diversified agricultural powerhouse that benefits from growing global food demand. Second, and perhaps most overlooked, is Brazil's role as a critical minerals supplier. As the world races toward electrification and clean energy, the demand for minerals like copper, cobalt, and lithium is projected to skyrocket. Electric vehicles require up to 6 times more minerals than conventional cars, and renewable energy technologies are similarly resource-intensive. Brazil's abundant mineral reserves position it perfectly to capitalize on this growing demand, creating a second pillar of economic strength. Third, Brazil is leveraging its natural resources to become a renewable energy powerhouse. The country's investments in hydropower have already established it as a leader in clean energy production, but it's not stopping there. Brazil is actively expanding its wind and solar capacity, positioning itself to benefit from the global energy transition while reducing its own dependence on fossil fuels. This creates yet another avenue for sustainable economic growth that many investors are completely overlooking. The numbers tell the story that headlines aren't capturing. Brazil-focused ETFs like the iShares MSCI Brazil ETF, EWZ, have rebounded impressively, reflecting growing investor confidence in the country's economic trajectory. After years of disappointing performance, these funds are now delivering returns that justify a second look from global investors seeking alternatives to overvalued U.S. stocks. But the real opportunity lies beyond the broad market ETFs. Individual Brazilian companies are showing remarkable strength that rivals anything you'll find in more hyped markets. Take WEG, for example, a Brazilian industrial company that specializes in electric motors and renewable energy equipment. While most Americans have never heard of it, WEG has delivered an astonishing 25% average annual return over the past decade. That's not just good, it's exceptional by any standard, rivaling the performance of much more celebrated tech companies. What's particularly interesting about Brazil's rebound is how it's happening alongside the growth of its middle class. Rising incomes are fueling domestic consumption, creating opportunities for consumer-focused companies alongside the resource exporters. This two-pronged growth engine, exports plus domestic consumption, provides resilience that purely export-dependent economies often lack. Brazil also offers something increasingly rare in today's global economy: a potential hedge against US-China tensions. As trade relationships become more complicated and supply chains more fragmented, Brazil's position as a neutral resource supplier to both economic superpowers creates strategic advantages. American and Chinese companies alike are seeking resource security, and Brazil stands ready to supply both markets. For investors concerned about valuation, Brazil offers an attractive entry point compared to frothy US markets. While American stocks trade at historically high multiples, many Brazilian companies offer compelling valuations with stronger growth prospects. This valuation gap creates a margin of safety that's increasingly hard to find in developed markets. Of course, Brazil still comes with risks. The country's political landscape remains complex, and economic reforms progress in fits and starts rather than smooth trajectories. Currency fluctuations can impact returns for dollar-based investors, and commodity price volatility remains a factor for this resource-rich economy. But these risks need to be viewed in context. The Brazil of 2024 isn't the Brazil of 2015. Economic fundamentals have improved dramatically, corporate governance has strengthened, and the country's position in critical global supply chains has only grown more strategic. For investors willing to look beyond negative headlines and outdated perceptions, Brazil offers a compelling opportunity to access growth at reasonable valuations. The question isn't whether Brazil deserves a place in globally diversified portfolios. It's how much exposure makes sense given your investment goals and risk tolerance. For investors seeking alternatives to expensive US stocks and low-yielding bonds, even a modest allocation to Brazilian assets could significantly enhance returns while providing valuable diversification benefits. What's particularly exciting about Brazil's comeback is how it's happening alongside other positive developments across Latin America. The region as a whole is experiencing a resurgence in investment interest, with Brazil leading the way as its largest economy. This regional momentum creates additional tailwinds for Brazilian companies, especially those with pan-Latin American operations. For investors wondering how to gain exposure, options range from broad market ETFs like EWZ to more targeted funds focusing on specific sectors such as agriculture or resources. More adventurous investors might consider individual ADRs, American depositary receipts, of leading Brazilian companies that trade on U.S. exchanges, offering direct exposure to the country's strongest performers. Eastern Europe's hidden gems, high growth at value prices. While Brazilian ADRs offer direct exposure to Latin America, there's another region where your investment dollars might stretch even further. Eastern Europe sits at a fascinating crossroads. Countries with EU membership benefits and regulatory frameworks, but priced like emerging markets, creating what might be the most overlooked value opportunity on the global stage today. What makes Eastern Europe so special? It's not just about cheap stocks, it's about getting European stability with emerging market growth rates. Countries like Poland, Hungary, and Romania operate with the safety net of EU membership while delivering economic performance that puts many Western nations to shame. Let's talk numbers that will make you question your portfolio allocation. Poland has achieved something remarkable, closing 45% of the GDP per capita gap with G7 countries. Think about that for a second. We're talking about a nation that's nearly halfway to matching the world's wealthiest economies while trading at bargain basement prices. The valuation gap is where things get really interesting. Eastern European markets are currently trading at a 44% discount compared to the S&P 500. That's not just a small difference, it's nearly half the price. And it's way beyond the long-term average discount of 29%. In simple terms, you're getting similar or better growth potential at almost half the cost of US stocks. What's driving this growth? One major factor is nearshoring, a trend that's reshaping global supply chains. As European companies have learned painful lessons about depending on far-flung suppliers, they're moving production closer to home. And guess who benefits? Eastern European nations that offer skilled workers at significantly lower costs than Western Europe. Manufacturing in Poland or Hungary gives European companies the perfect balance. They get reliable, skilled labor without Western European prices, plus simplified logistics with fewer time zones and cultural barriers to navigate. It's like getting the best of both worlds. European quality standards with emerging market cost structures. But the opportunities don't stop at manufacturing. Eastern Europe is perfectly positioned to capitalize on the global energy transition. As demand for critical minerals skyrockets to power everything from electric vehicles to renewable energy storage, these countries are leveraging their natural resources and improving infrastructure to attract serious foreign investment. The performance numbers tell an impressive story too. Eastern Europe-focused ETFs have shown remarkable resilience compared to the S&P 500, often outpacing broader emerging market indices during economic recovery periods. This means you're not just betting on potential. These markets have already demonstrated their ability to deliver strong returns. What makes this opportunity even more compelling is that most Western investors completely overlook these markets. While everyone argues about whether the S&P 500 is overvalued or debates the latest tech stock bubble, Eastern Europe quietly continues its economic convergence with minimal attention from Wall Street. Poland stands out as the region's star performer. Its 45% GDP per capita convergence with G7 nations makes it one of the most successful emerging economies globally. Yet its stock market doesn't reflect this success story, creating a disconnect between economic reality and market valuations that smart investors can exploit. Think about this disconnect for a moment. If a U.S. company was growing at the rate of these Eastern European economies while trading at a 44% discount to its peers, investment analysts would be shouting about it from the rooftops. But because these opportunities sit across the Atlantic, they remain hidden gems for most American investors. The EU membership of these countries provides a crucial safety net that many emerging markets lack. These nations operate under European regulatory frameworks, reducing some of the governance and corruption concerns that often plague emerging market investments. You get emerging market growth potential with a significantly improved risk profile. And let's talk timing. With U.S. markets at historically high valuations and many investors worried about limited upside, these discounted Eastern European markets offer a compelling alternative. When markets eventually rotate from growth to value, as they inevitably do, regions trading at significant discounts tend to benefit disproportionately. For investors looking to diversify beyond the usual international suspects, countries like Poland, Romania, and Hungary provide exposure to different economic cycles, different demographic trends, and different growth drivers than you'll find in the typical American portfolio. The beauty of Eastern Europe's position is its unique blend of stability and growth potential. While fully developed markets offer stability with modest growth, and frontier markets offer high growth with high risk, Eastern Europe sits in that perfect middle ground, providing enhanced stability compared to other emerging markets while retaining significant growth potential. What's particularly attractive about this opportunity is that you don't need specialized accounts or complex investment vehicles to participate. Several ETFs focused on Eastern Europe trade on U.S. exchanges, making it as easy to buy these markets as it is to purchase shares of Apple or Amazon. If you're wondering why these markets trade at such steep discounts despite their economic progress, it largely comes down to perception and awareness. The investment community has narratives about different regions: tech innovation for the US, manufacturing for Asia, commodities for Latin America. But Eastern Europe hasn't yet developed its defining investment narrative despite its impressive economic transformation. This awareness gap creates opportunity. Markets eventually correct these discrepancies, and when they do, early investors stand to benefit substantially. The very fact that these markets are overlooked contributes to their attractive valuations, creating a situation where informed investors can position themselves ahead of the crowd. With inflation concerns and potential interest rate volatility affecting markets globally, it's worth noting that many Eastern European countries have taken significant steps to strengthen their economic fundamentals. They've learned tough lessons from previous economic cycles. Investment vehicles, the easiest ways to access global growth. Those resilient Eastern European economies aren't just economic success stories. They're investment opportunities you can access right now through your regular brokerage account. That's right, you don't need special permissions, foreign bank accounts, or a financial advisor on speed dial to tap into these markets. The tools to diversify globally are already at your fingertips. Let me guess, you've always thought investing internationally meant complicated paperwork, currency conversions, and maybe even a passport? You're not alone. This is one of the biggest misconceptions keeping Americans locked into their home market. The reality is that accessing these high-growth regions requires nothing more than the same platform you use to buy Apple or Tesla stock. ETFs, exchange-traded funds, are your gateway to global markets. These simple investment vehicles trade on U.S. exchanges just like stocks, but they give you instant exposure to entire countries or regions. Want to invest in India's digital revolution? There's an ETF for that. Interested in Vietnam's manufacturing boom? There's one for that too. These funds handle all the complexities of international investing behind the scenes while you simply click buy from the comfort of your living room. Let's talk about the performance kings in this space. The WisdomTree Emerging Markets Small Cap Dividend ETF (DGS) has been the standout performer among emerging market funds over the past decade. A $10,000 investment would have grown to over $17,000. That's a compelling return for simply clicking a button. Not far behind are FEMS, First Trust Emerging Markets Small Cap Alpha DX ETF, and EWX, SPDR S&P Emerging Markets Small Cap ETF, both turning the same $10,000 investment into more than $17,000 over that period. For broader international exposure, the iShares MSCI EF ETF, EFA, gives you access to developed markets outside North America. With an expense ratio of just 0.38% and a current NAV around $80, it's an affordable way to diversify across Europe, Australia, and Asia's developed economies. If you're looking for country-specific opportunities, consider the Matthews Korea Active ETF. This fund focuses on secular growth opportunities in Korea's dynamic economy. While its expense ratio is higher at 0.79%, the active management approach seeks out companies with sustainable business models positioned for long-term appreciation. Speaking of Brazil, if you're intrigued by its resource-rich economy, the Global X Brazil Active ETF, BRAZ, offers targeted exposure. Keep in mind that actively managed funds like this one might have higher transaction costs and potential tax implications from short-term gains, something to consider when comparing them to passive alternatives. One of the most accessible options for broad emerging market exposure is Vanguard's VWO. With an incredibly low expense ratio of just 0.07%, your investment dollars are working harder for you rather than padding fund manager pockets. That efficiency translates directly to better returns compared to higher fee alternatives. But what about buying individual international companies directly? This is where ADRs, American Depository Receipts, come in. These are certificates issued by U.S. banks that represent shares in foreign companies, but trade on U.S. exchanges in U.S. dollars. Think of them as the international investing hack that eliminates the need for currency conversion or foreign brokerage accounts. Major foreign companies like Samsung, Alibaba, and Petrobras all trade as ADRs on U.S. exchanges. You can buy them just as easily as you'd purchase shares of Microsoft or Amazon. The beauty of ADRs is that they give you direct exposure to specific companies you believe in, rather than spreading your investment across an entire country or region. Now, should you choose active or passive international funds? The data speaks volumes here. Actively managed international funds have consistently struggled to outperform their passive counterparts, with their net returns trailing benchmarks by an average of 1 to 1.5% annually. This performance gap is particularly pronounced since 2000, when international large-cap funds have mostly failed to beat their benchmarks after fees. This doesn't mean active management never works. Some managers do outperform, but the odds aren't in your favor. Given the higher fees and historical underperformance, passive ETFs typically offer better value for most investors venturing into international markets. When considering which international vehicles to choose, it's important to understand the cyclical nature of global returns. U.S. stocks have outperformed international stocks in 8 of the last 10 years, but zoom out and you'll see a different picture. International markets have historically shined precisely when U.S. returns have lagged. This brings us to perhaps the most compelling case for adding some VWO to your portfolio. During periods when U.S. stock returns fall below 6%, VWO has typically delivered superior performance. This pattern has occurred 96% of the time, highlighting the value of global diversification as a portfolio stabilizer. Let's get practical about allocation. How much should you consider placing in these international vehicles? Financial experts typically recommend between 20 to 40% of your equity portfolio be allocated internationally, with perhaps a quarter to a third of that in emerging markets specifically. This isn't about going all in on any single country or region. It's about strategic diversification. What makes emerging market ETFs particularly attractive right now is their current valuations. Many are trading at significant discounts compared to US markets, which are near historic highs. When you buy into these funds, you're essentially getting more earnings potential per dollar invested. A common mistake people make is trying to time their entry into international markets. Rather than attempting to pick the perfect moment, consider dollar cost averaging, investing a fixed amount regularly regardless of market conditions. This approach removes the emotional component and often results in better long-term performance. For those concerned about fees eating into returns, ETFs like VWO offer remarkable efficiency. At just 0.07%, the expense ratio is a fraction of what many actively managed funds charge. Over decades of investing, this difference compounds dramatically, potentially adding tens of thousands of dollars to your retirement savings. It's worth noting that some international ETFs also offer higher dividend yields than their US counterparts. This provides not only growth potential but also current income, a valuable combination, especially for investors approaching retirement who seek both appreciation and cash flow. What if you're interested in frontier markets, the economy's positioned to become tomorrow's emerging markets? Funds like iShares MSCI Frontier 100 ETF provide exposure to early-stage growth opportunities in countries that aren't yet on most investors' radar. These investments typically carry higher risk, but potentially higher long-term rewards. For those worried about currency fluctuations, currency-hedged ETFs are available that minimize the impact of exchange rate movements on your returns. These funds use financial instruments to neutralize currency effects, allowing you to focus purely on the underlying market performance. Managing the risks, currency, politics, and market maturity. Currency risk isn't just theoretical. It's probably the hidden factor determining whether your international investments sink or soar. While we've covered the vehicles that can take you into global markets, let's tackle what's really holding most people back. The risks, both real and imagined, of venturing beyond US borders with your hard-earned money. When I talk to investors about going international, three concerns come up repeatedly: currency fluctuations, political instability, and market maturity. These are legitimate concerns, but they're often blown way out of proportion. Let's break them down one by one and see what the data actually tells us. First up, currency risk. This is the game changer most investors never fully understand. When you invest internationally, you're not just betting on companies. You're also making an implicit bet on their local currency against the US dollar. This works both ways. When the dollar weakens, your international returns get a boost. But when the dollar strengthens, your returns can take a serious hit. The past decade has been particularly brutal for unhedged international investors. The US dollar appreciated over 30% from 2014 to 2024, which means even if your foreign stocks did well in their local markets, much of those gains evaporated when converted back to dollars. Imagine watching your investments grow by 20% in their local currency, only to end up with a 10% return after currency conversion, or worse, a loss. But here's what most financial advisors won't tell you. Currency movements tend to be cyclical. Periods of dollar strength are typically followed by periods of dollar weakness. The smart play isn't avoiding international markets altogether. It's having a strategy for managing currency exposure. This is where currency-hedged investments come into the picture. These funds use derivatives like options and futures contracts to neutralize the impact of exchange rate movements. Think of them as insurance policies against currency swings. They cost a bit more in fees, but during periods of dollar strength, they've preserved returns that would have otherwise disappeared. For example, if you're particularly worried about currency impacts, you might consider allocating a portion of your international exposure to hedged ETFs. During times when the dollar is strengthening, these funds typically outperform their unhedged counterparts, sometimes by significant margins. The second major concern is political risk. What happens if you invest in a country that experiences a coup, nationalizes industries, or implements capital controls? These scenarios sound terrifying, and they make for dramatic headlines, but the historical data paints a more nuanced picture. Political changes, even dramatic ones, often have less long-term impact on market returns than investors fear. Markets in countries undergoing significant political transitions have frequently bounced back stronger after initial volatility. While emerging markets are more vulnerable to political risks, they've also shown remarkable resilience over time. What many investors don't realize is that political risk is often already priced into emerging market valuations. Those discounted valuations we discussed for Eastern European markets, they partly reflect the political risk premium investors demand. When political situations stabilize or improve, these markets can experience dramatic upside as the risk premium diminishes. The key to managing political risk isn't avoidance, it's diversification. By spreading your international exposure across multiple countries and regions, you limit the impact any single political crisis can have on your overall portfolio. This is another reason why broad ETFs can be particularly valuable for newer international investors. The third major concern is market maturity. Investors worry about trading in less developed markets with potential liquidity issues, lower transparency, and fewer regulatory protections. These concerns are valid, but they've diminished significantly over the past 2 decades. Many emerging markets have dramatically improved their financial infrastructure, reporting requirements, and investor protections. While they may not match U.S. standards in every respect, the gap has narrowed considerably. Additionally, by investing through U.S.-listed ETFs and ADRs, you gain many of the regulatory protections of the U.S. financial system while still accessing international growth. Liquidity concerns are often overstated for average investors. Unless you're managing millions of dollars, the liquidity available in most emerging market ETFs is more than sufficient for your needs. The typical retail investor simply doesn't trade in volumes large enough to encounter serious liquidity constraints. Now, what about the optimal allocation? How much international exposure makes sense given these risks? The research is surprisingly clear on this. Studies suggest that allocating between 20% and 50% of your portfolio to international assets provides the maximum volatility reduction benefit. This range has been consistently supported by decades of market data. What's fascinating is that many investors assume adding international exposure increases their portfolio's overall risk. The data shows exactly the opposite. Due to the imperfect correlation between U.S. and international markets, adding global exposure actually reduces portfolio volatility over the long term. It's counterintuitive, but mathematically sound. Your all-American portfolio may actually be riskier than one with global diversification. Think about it this way. When U.S. markets are struggling, international markets are often performing differently. Sometimes better, sometimes worse, but rarely in perfect lockstep. This imperfect correlation is what creates the diversification benefit. During the 2000 to 2009 period, often called the lost decade for U.S. stocks, many international markets delivered positive returns while the S&P 500 went nowhere. What's the right allocation for you personally? That depends on your age, investment timeline, and risk tolerance. Younger investors with longer time horizons can generally afford to be more aggressive with international allocations, potentially pushing toward that 40 to 50% range. Investors closer to retirement might prefer to stay in the 20 to 30% range to limit short-term volatility. One approach that works well for many investors is to start small and increase gradually. If you currently have zero international exposure, don't rush to put 40% of your portfolio overseas. Start with 10 to 15% and increase it over time as you become more comfortable with how these investments behave in different market conditions. Remember that emerging markets, while offering higher growth potential, also come with higher volatility. A reasonable approach might be to allocate a portion of your international exposure to developed markets, Europe, Japan, Australia, and a portion to emerging markets, with the split depending on your risk tolerance. The beauty of today's investment landscape is that you can fine-tune your exposure precisely. Want more India but less Brazil? More Vietnam but hedged against currency risk? Specific ETFs exist for nearly any combination you can imagine. This allows you to customize your international allocation based on your convictions about specific markets and your comfort level with different types of risk. One final thought on risk management. Consider using dollar cost averaging when entering international markets. Rather than moving a large chunk of your portfolio overseas at once, invest gradually over time. This reduces the risk of buying in at a temporary market peak and can help smooth your entry into more volatile markets. The next frontier, tomorrow's emerging market stars. Beyond established emerging markets lies a hidden world of frontier economies where truly life-changing returns are still possible. Ever wondered where the next economic miracle will emerge? The countries poised to deliver the next decade's most explosive growth aren't the ones making headlines. They're the ones quietly building trillion-dollar industries while flying completely under Wall Street's radar. While we've explored opportunities in more established markets like India, Vietnam, and Brazil, there's an even more exciting frontier for investors willing to venture further off the beaten path. These frontier markets represent economies at earlier stages of development, but with tremendous growth potential that could dwarf even today's emerging market stars. Let me introduce you to Guyana, a small South American nation that's experiencing what can only be described as an economic revolution. Following ExxonMobil's massive oil discoveries in 2015, Guyana's economy has undergone a stunning transformation, growing fourfold in just 5 years. This isn't just impressive, it's unprecedented in modern economic history. The numbers are staggering. Guyana is projected to maintain a compound annual growth rate of 19.8% through 2029. Just let that sink in for a moment. While developed economies celebrate 2 to 3% growth, Guyana is growing at nearly 20% year after year. By 2028, this small nation is expected to have the highest crude oil production per capita globally, surpassing even Kuwait. That's like finding out your quiet neighbor suddenly became a billionaire overnight. But Guyana isn't the only hidden gem in the frontier market universe. Let's head across the Atlantic to Mozambique, where another economic transformation is underway. This East African nation is projected to achieve a 7.9% compound annual growth rate through 2029, driven largely by its abundance of critical natural resources. What makes Mozambique particularly interesting is its position in the global energy transition. As the world shifts toward renewable energy and electric vehicles, the demand for key minerals is skyrocketing. According to research from S&P Global, copper demand alone is expected to double from 25 million metric tons today to about 50 million metric tons by 2035. Countries rich in these resources, like Mozambique, stand to benefit enormously from this unprecedented demand surge. Then there's Rwanda, which is projected to grow at 7.2% annually through 2029. Unlike Guyana and Mozambique, Rwanda's growth isn't primarily resource-driven. Instead, this small landlocked country is positioning itself as Africa's technology hub through aggressive government policies promoting innovation and digitalization. Think of Rwanda as the Singapore of Africa, a small nation leveraging education, technology, and good governance to punch far above its economic weight. Now, I know what you're thinking. These amazing growth stories sound great, but how exactly do I invest in places like Guyana or Rwanda? It's not like you can just open your brokerage app and buy shares of the Guyana Oil Company. And you'd be right to ask that question. This is where frontier market ETFs come into play. Funds like FM, the iShares MSCI Frontier 100 ETF, provide investors with diversified exposure to these high-potential economies. Rather than trying to pick individual stocks in unfamiliar markets, these ETFs offer a basket of companies across multiple frontier countries, managed by professionals who understand the unique challenges and opportunities these markets present. But let's be clear about something. Investing in frontier markets isn't for the faint of heart. These investments come with higher volatility than even traditional emerging markets. Political changes can happen quickly, currencies can fluctuate dramatically, and market regulations may not be as robust as what you're used to in developed countries. The flip side, potentially astronomical returns that simply aren't possible in more mature economies. When a country's GDP is growing at 19.8% annually, that creates a rising tide that can lift many investment boats. And because these markets are still relatively undiscovered by mainstream investors, valuations often remain attractive despite the growth potential. What's particularly interesting about frontier markets is how they often march to their own economic drumbeat. When global markets tumbled during various crises, certain frontier markets showed remarkable resilience, continuing their growth trajectories relatively unaffected by Wall Street's ups and downs. This low correlation with developed markets makes frontier investments a powerful diversification tool beyond just chasing higher returns. Think about it this way. 20 years ago, few American investors were seriously considering China as an investment destination. Those who did capture China's explosive growth period saw returns that transformed modest investments into substantial wealth. Today's frontier markets might represent similar opportunities, getting in on the ground floor of the next generation of economic success stories. The performance patterns of frontier market ETFs reveal something fascinating. While they can underperform during periods of strong developed market bullishness, like the recent U.S. market rally, they've historically shown remarkable outperformance during recovery periods and when investors seek alternatives to expensive developed markets. As U.S. market valuations sit near historic highs, these overlooked corners of the investment world offer both growth potential and relative value. For investors interested in capturing these opportunities, a modest allocation of 5 to 10% of your international portfolio to frontier markets can provide meaningful exposure without taking excessive risk. This isn't about betting your retirement on Guyana's oil boom. It's about strategically positioning a portion of your portfolio to capture growth that most investors aren't even aware exists. The emerging markets of today were yesterday's frontier markets. Vietnam, now considered an emerging market success story, was once viewed as too risky and undeveloped for serious investment consideration. The same transformation is likely happening right now in countries that will become household investment names a decade from now. What makes these opportunities particularly exciting is the combination of macroeconomic tailwinds and company-level innovation. In Guyana, it's not just about pulling oil from the ground. It's about how this newfound wealth is creating an entire ecosystem of businesses to service the energy sector and the growing consumer economy. In Rwanda, tech startups are creating African solutions for African challenges, with applications that may eventually scale globally. Remember this key principle of frontier market investing. Patience and perspective are your greatest allies. These investments will likely experience periods of dramatic volatility, but the long-term growth trajectory can more than compensate for the bumpy ride. It's about capturing the entire arc of a country's economic development, building a globally diversified, not just quarterly returns. The patience and perspective we've discussed throughout this journey aren't just philosophical concepts. They're the foundation of a practical investment strategy. The difference between knowing about global opportunities and actually profiting from them comes down to having a clear action plan. Did you know that most investors who try international markets fail not because of poor performance, but because they use the wrong approach from the start? I'm about to show you the exact three-step process that transforms intimidating foreign markets into a straightforward wealth-building strategy that works with your existing brokerage account. The biggest obstacle preventing Americans from capitalizing on global growth isn't access to markets. It's our own psychology. We've been conditioned to see international investments as too risky or too complicated, when in reality they're neither. The real risk is keeping all your eggs in one basket, especially when that basket, the U.S. market, is currently at historically high valuations compared to the rest of the world. Let's break down your global investing action plan into 3 simple steps anyone can follow. Step 1. Determine your optimal international allocation based on your personal situation. This isn't one size fits all. Your age, financial goals, and risk tolerance all play crucial roles. Conservative investors typically do well with around 20% allocated to international equities. If you're in the moderate camp, consider bumping that up to 30 to 40%. And for those with longer time horizons or higher risk tolerance, allocations of 50% or more to international markets can maximize your growth potential. Your age is particularly important here. If you're in your 20s or 30s, you can afford to be more aggressive, potentially allocating 40 to 50% internationally. As you move into your 40s and 50s, scaling back to 30 to 35% might make more sense. And if you're approaching retirement, a more conservative 20 to 25% international allocation provides diversification without excessive volatility. Remember, this isn't an all-or-nothing decision. You can start with just 10 to 15% in international markets and gradually increase your exposure as you become more comfortable with how these investments perform in your portfolio. Step 2. Select the right investment vehicles for your international exposure. This is where many investors get overwhelmed, but it's actually quite straightforward. I recommend a 3-tier approach for most investors. Tier 1 should be broad-based international ETFs that give you diversified exposure across many countries. These form the foundation of your international allocation. For conservative investors, the iShares MSCI ETH ETF (EFA) is an excellent choice, focusing on developed markets outside the US and Canada with stability and lower volatility. Tier 2 consists of targeted regional or country-specific ETFs that align with your highest conviction investment themes. If you're particularly bullish on the growth stories we've discussed, you might allocate a portion to specific ETFs focused on India, Vietnam, Brazil, or Eastern Europe. Tier 3, for more experienced investors, might include individual ADRs of standout companies in these markets. This tier should generally be the smallest portion of your international allocation, perhaps 10 to 20% of your international holdings. The beauty of this approach is its flexibility. Conservative investors might stick primarily with Tier 1, while more aggressive investors could weight more heavily toward Tiers 2 and 3. Step 3. Implement a dollar-cost averaging strategy to reduce timing risk. This is perhaps the most important yet overlooked aspect of successful international investing. Rather than trying to time your entry into these markets, which even professionals struggle to do consistently, commit to investing a fixed amount at regular intervals. For example, if you've decided to shift $10,000 into international markets, consider investing $1,000 monthly over 10 months rather than all at once. This approach helps smooth out the market's inevitable ups and downs and reduces the psychological stress of seeing your investment temporarily decline if markets dip shortly after your purchase. Dollar-cost averaging works particularly well with volatile emerging markets because it ensures you're buying more shares when prices are low and fewer when prices are high, potentially improving your long-term returns. This strategy has repeatedly proven effective in navigating emerging market volatility while capturing their growth potential. Now, let's look at some concrete portfolio models for different investor profiles. For conservative investors, consider a portfolio consisting of 60% US stocks, 20% international stocks, and 20% bonds. Within that 20% international allocation, you might put 15% in developed markets through funds like EFA and just 5% in broader emerging market ETFs like VWO. A moderate portfolio might include 50% US stocks, 30% international stocks, and 20% bonds. Your 30% international piece could be split with 15% in developed markets, 10% in broad emerging markets, and 5% in targeted country-specific ETFs focusing on the high-growth regions we've discussed. For aggressive investors, a portfolio with 40% US stocks, 50% international stocks, and 10% bonds could maximize growth potential. Within that substantial 50% international allocation, consider 20% in developed markets, 20% in broad emerging markets like the Global X Emerging Markets ETF, EMFM, and 10% in specific high-conviction markets or individual ADRs. These allocations aren't set in stone. They're starting points you can adjust based on your comfort level and market conditions. The key is establishing a disciplined approach that you can maintain through market cycles. Let's talk numbers. What kind of impact could this international diversification have on your long-term wealth? Research indicates that adding just a 20% allocation to emerging markets could potentially increase your portfolio returns by 1 to 2% annually. That might not sound like much at first, but compound that over a 20-year investment horizon, and you're looking at potentially 25% more wealth in your retirement account. Think about it this way. A $100,000 portfolio growing at 7% annually would be worth about $387,000 after 20 years. Bump that return up to 8.5% through strategic international diversification, and you're looking at approximately $514,000, an additional $127,000 for retirement. That's the difference between a comfortable retirement and one with significant financial flexibility. The average annualized return for international equities has historically been higher than for U.S. equities during periods of low U.S. stock returns. With U.S. markets at historically high valuations, international stocks may be primed for a period of outperformance in the coming years, making now a particularly opportune time to rebalance your portfolio. It's worth noting that the impact is even more dramatic for younger investors with longer time horizons. An extra 1 to 2% return compounded over 30 or 40 years can literally mean the difference between retiring with $1 million or $2 million. What stops most people from making these portfolio adjustments isn't lack of information, it's inertia. We tend to stick with what's familiar, even when data shows there may be better approaches. That's why I recommend setting a specific date, perhaps this weekend, to review your current allocation and take the first step toward a more globally diversified portfolio. Remember, you don't need to overhaul your investment strategy overnight. Start with a modest reallocation, perhaps 5 to 10% of your portfolio, and increase it gradually as you become more comfortable with international exposure. The most important thing is to take that first step. As we wrap up today's global investment journey, I want to emphasize one powerful insight from billionaire investor Mark Cuban. Diversification is key to managing risk in your portfolio, and international investments can provide that diversification. Investing globally allows you to tap into growth opportunities that may not be available in the U.S. market. And he's absolutely right. The investment world stretches far beyond America's borders, with emerging economies projected to drive over 50% of global GDP growth in the coming years. These aren't just statistics. They represent potential wealth-building opportunities for those willing to look beyond their comfort zone. Don't let this be the financial decision you look back on with regret. Take just 15 minutes this week to examine your international allocation. The biggest financial regrets rarely come from actions we took, but from the opportunities we let slip through our fingers while focusing only